Bismillahirrahmanirrahim. Assalamu alaikum and welcome to another lecture. In our last lecture, we started our chapter named Risk Management. We understood that what is risk, how the risk from different company to company varies, different industry to industry varies, and what are the types of the risks are, and how we are going to classify the risk into each type or each category. All right. So now let us move towards the one of the core area of this topic or this chapter, that is the risk management. And you know what? What if I make this thing very easy for you, that everyone says that risk management, or don't know how difficult this thing is. How about if I tell you that risk management is very simple? Risk management is a very simple activity or a simple process to understand, not to do. To understand so that you can understand and then apply it. So the risk management is basically the process in which you reduce the risk. Sir, is this really a risk management? Yes, it is. But the risk management means that you reduce the risk. And you know what? When I says that reduce the risk, it means reducing two things. Number one is the impact. Number one is the impact, and number two is the likelihood. That means that there is an event, there is a future event, and you have a risk that if that future event will happen, it will bring the negative results for me. It will bring the negative consequences or the unfavorable, undesirable outcomes for me, right? This is your risk. How about if I would say that if you could decrease the impact? Impact means that the uh, disadvantages or the result it is going to bring for you, the consequences it is going to bring for you. So if you could reduce the impact, then I would say okay, you have reduced. Because for example, let's say when you go out from the home to reach any destination or any place where you want to go, maybe you ride the bike through it, you ride bicycle, you drive the car. So there is a risk that you might encounter an accident in between, God forbid, but there is a risk. So, how can you say that what are the impacts in it? So, when I talk about the impacts of the accident, is that maybe someone, not I'm talking not about you, you are very dear to me. So, I'm saying that if someone encounters the accident, so that person could lose its life. Maybe that person could face the severe casualties or severe damages, or maybe the person could face or encounter the severe or very significant disabilities, maybe his hand, leg, or anything, eyes. uh, don't need to think about it, they can lose them. So these are the impacts, right? And when I talk about the likelihood means that the chances of this event happening, right? The chances of this event happening. So for example, if you are a very rash driver, if you are a very rough rider, so there are high likelihood that you might face an accident. Or maybe you are going through a route, that route is very busy, the big trawlers, big trucks are going along with you. So there is a high likelihood of the accident, right? So the impact and the likelihood, this is the thing. So when I talking about the managing risk means that you reduce either the impact or either the likelihood. For example, the accident example, you drive carefully, you have installed the airbags into your car, you have applied the seat belt. So these are the precautions through which you have what you have reduced the impact, so that if God forbid you encounter an accident, so the chances, or the I would say impact, would be very low. That due to airbag you would not be damaged, due to the seat belt you would be safe, right? So these are the things which are going to decrease the impact which are going to occur due to the accident. So the event is going to happen, but the impacts you have normalized or you have minimized. All right. The likelihood means that you reduce the chances of the accident by, for example, you drive carefully, you take some other route, right? You follow all the traffic instruction, all the driving instruction. So and also you focus on the other people as well, that from where they are coming, how they are driving, and you try to save yourself from them. So through this you can reduce the likelihood of the accident, and this is what basically the risk management is. But there is one thing that you need to understand, that when you reduce the impact and you reduce the likelihood, it requires some cost. Obviously, for airbag, for seat belt, you have to drive slow, so you will take more time. You have to take care of the traffic regulation rules, you have to study them, you have to memorize them, right? So all these things, they have some cost, right? Maybe monetary, maybe non-monetary. So a company will always consider this thing, that to reduce the likelihood or to reduce the impact, how much cost they need to incur. For example, let me give you an example, that there is a account receivable which your company have. This is the account receivable of $100, and this account receivable will pay you 10 days late. 10 days late. So obviously when the account receivable is paying you 10 days late, we all know there is a cost of capital. And due to this 10 days delay, obviously you would face the capital issues, you would face the liquidity issues, you would face the cash flow issues. So there is a cost due to this, and this is your risk, right? So for example, you went to a discounting house, you went to a discounting company. What is the discounting company? For those students, if they don't know, let me just give you a quick hint about it, that these are the companies, they will purchase the account receivable for you from you, and they will give you the quick money. For example, $100, they will give you $90, and they will say that forget about your account receivable, you have received your $90 in place of these $100. Now this is our responsibility, this is our headache, we will recover it. If we recover it, it's ours. If we do not recover it, also loss is ours. You do not have any tension to take. This is the discounting company. So did you notice one thing, that for that $90 quick cash, $90 on spot payment, and to eliminate this delay, you have to pay $10 fees. You have to incur the $10 cost. So as a company, you have to analyze this thing, that this $10 cost is bigger, or this 10 days delay is bigger. All right. So that is how you do the risk management, that you analyze and you evaluate that in order to reduce the risk, this is your risk, 10 days delay, what cost you need to pay. If that cost is even bigger than the damage which you are going to face because of the risk, then you say that okay, we are not going to reduce the risk, or we are going to accept the risk. Or maybe you would go to a discounting house and you would say, okay, right now we don't need the spot payment. Maybe give us the payment after 5 days. So for 5 days, the discounting house would say maybe that, okay, we will charge $5 fees. We will charge $5 fees. So maybe this $5 fees is less than the damage of your risk. So then you will accept it. And you know why I am explaining this thing? I am explaining this thing for our next topic. And that next topic is basically the risk appetite. The risk appetite. Appetite means that how much risk a company can accept. You know what? We have seen it in our real life as well. That there are few people who are risk taker, who likes risk in their life. And there are few people who are risk averse. They do not like taking risk. They like to have a safe position, safe condition in which they are not exposed to any risk. All right, they play safely. And there are some people who take risk. So, what is the difference between these two mentality, these two approaches? What is the reason behind it, that sir, one person is taking too much risk and the one person is taking not taking too much risk? You know what? This is the difference of the risk appetite. The risk appetite of the person who is risk taker is very high. That means that that person is accepting, or this person is ready to take the huge risk. That person can take the huge risk. And if the risk appetite of some person is low, that means that person is not ready to take the high risk. And that is what it means. For example, if there is a person who has a low risk appetite, who has a low risk appetite, so that person, you will always see that this person is incurring too much cost in reducing the risk, in reducing the impact or the likelihood. And if there, on the other hand, if there is a person who has a high risk appetite, who has a high risk appetite, that person would be spending little amount of money or the resources in reducing the impact or likelihood, because that person is ready to take the risk. Now the question comes that, sir, which person is better? Which approach is better? What we should do? The answer is that both are correct. No one is wrong. This is based on the scenario of both of the companies, both of the people. Because as per your scenarios, as per your company position, you have to take the risk. For example, if you are a listed company, if you have a money or funds of the large public, you cannot take too much risk, because you have to take care that you have the money of the people who are domestic background, who have the very few funds. So you cannot take the blind risk with this their money. You cannot make the rash decisions, right, in order to earn the returns, because this is a very universal truth, that in order to earn the return, in order to have the return, you have to accept some risk as well. But you have to manage this thing as per your appetite, that how much risk are you going to accept, and whatever the risk you are going to accept, you will get the return accordingly. All right. So if, so based on your scenario, you will identify this thing, you will evaluate this thing, and both are correct approaches. And for example, if it is a startup company, if it is a entrepreneurial company, entrepreneurial business, then maybe the entrepreneur will take the high risk, because all money is his own money, and obviously he is not accountable to anyone, and it's a new company. So even if he incurs a losses, he will accept it because it's a start. But if there is a mature company, it's a big company, multinational company, then the board of directors would be too reluctant to take any risk that is unnecessary, because they know that they are in a good position, and they don't need to take extra risk, unnecessary risk, to earn the dramatic profits. All right, so they will be happy with it, and they will go with the risk averse approach and will safeguard the money of the other people. So both are correct, both are fine. It depends on which scenarios you are. All right, and then we have a connecting concept, that is the ALARP principle. What do we mean by ALARP principle? ALARP principle means that as low as reasonably practicable. It means that you should reduce the risk to such level that it is reasonably practicable. That we all know that, the risk graph, if I would make the risk graph, the risk is too high, but if you would decrease it, it will become like this, a flat line. That means that there is some sort of risk which will always exist, and you cannot you cannot eliminate that risk. The only way to eliminate the risk to the zero level is that you stop doing the business, you exit from the market, and that is the only way of eliminating the zero all risk. So that is why the ALARP principle says that okay, we understand that you cannot eliminate the complete risk, but try to reduce the risk to the low level as much as it is reasonably practicable. And you know what? Let me give you an example in continuation that we just talked about, that when you are going to one place to another place in a car, in a motorcycle or a bicycle, there is a chances that you might face an accident. So you should apply the ALARP principle and reduce your risk to as low as possible level. All right. But you all know that still there would be the risk, there would be the chances of accident. So that doesn't mean that you will stay at home and you will not go anywhere and you will not drive the car, you will not ride the bicycle or motorcycle. That doesn't mean this. So that is what the ALARP principle is saying, that you should minimize the risk to the low level as it is practicable. And you know, practicality also includes the cost which you are paying. And this is the practicality aspect, that if your cost of reducing the risk is more than the impact of the risk, then it is from nowhere a wise decision to incur such high cost, because you are incurring that much high cost which is having the higher impact than your impact. For example, if I would be the business leader, I would say that okay, let that risk be materialized, let that future event be happen, because that future event would happen and I will face a loss of $100 only. But if I would try to reduce this loss, maybe I will have to incur the cost of $200. So is it a wise decision to reduce the risk? No, not at all. So that is the practicality of the risk management, right? And that is what the Allah principle tells us. Let me give you one more example of the business. This was the real life example. Now I give you the business example. So the business example is that for example, you are selling your customers on credit, and it's a industry practice that all the customer purchases your product or any product on credit. No one makes the cash payment. On spot payment, it's not a tradition. What should we do? Because there is a risk that maybe your customer will default, maybe your customer will not pay on time, maybe your customer will not pay the complete amount. So you know, someone would come and say okay, then don't give them on credit, don't sell. But that's not the practical thing. You have to do the business, you have to exist in the market, and in market there is only one option, credit sale. So that means that the you cannot avoid the risk, but that doesn't mean that you will make the uncontrolled sales to everyone. You will not keep any check and balance and monitoring over the credit sales. You will study or research the background of the customer, you will check the history of the customer, and you will also check the capability of the customer to pay you on the time, so that you will be able to set a limit for the customer, right? When you will set a limit for the customer that we will only make you credit sales to this amount, let's say 10 million. After 10 million, if you want to purchase more from us, first clear the old dues. Once you will clear our old dues, only then we can give you more credit. So this is basically how you will reduce the risk, you will reduce the impact and the likelihood. But that doesn't mean that you will stop the business. So Allah principle teaches you this thing, that you should reduce the risk. You're not supposed to say that okay, if risk exists, we have to take the risk. Okay, take the full risk. No, Allah is saying reduce it, but also take care this thing, that how much practical it is, right? Because there is going to be always some sort of risk happen and you have to accept it, and you will accept it based on your risk appetite. So this is going to be the balance between the risk appetite and the risk which you are going to take, all right, and the practicality. So if we are clear till this thing, now let us move to the such some core area, or I would say the practical area, that how you are going to do the risk management in real. Like what are the steps you are going to follow in order to do the risk management? Because in exam it is always tested that maybe you would be required to tell the steps to be taken to do the risk management, or maybe you would ask the roles and responsibility of the risk management manager or the risk committee. So these are the all things which are done to manage the risk. These are the roles and responsibilities of the risk management. These are the roles and responsibilities of the risk committees. All right, so now let us read them. So first thing is that you should have the commitment from the top management, that means the board of director and the senior management. And it's a very simple thing, believe me, that for example, in your house, your father makes a new rule that now everyone should come in home at 8 p.m. Like after 8 p.m. no one will be outside the home. He made the rule, but he himself is violating this. He himself is not following this. And if someone is staying outside the home after 8 p.m., he is not taking any action. He is not asking any question. So that means that he has made the rule, but he is not serious about it. He is not committed to it. And similarly, in any organization, if you want to do a good risk management, that means that the tone or the seriousness or the commitment, this should be set from the top. Because if the top management is serious about it, if the top management is committed about it, only then the people in the lower hierarchy, your employees, your managers, your supervisors, your workers, labor, everyone is going to follow it because the top management is following it. If the top management is not following the risk management procedures, risk management strategies, or the risk management approaches, then do you think that they will take this thing seriously? No chance. That is why the commitment from the top is very very important. Understood? Now let's move forward. Creating a formal risk committee at board level. Now the thing is that how much importance you are giving to the risk management, it shows or it is seen from the committee which you have made. If you have made a dedicated risk management committee, it's a subcommittee of the board which we have already studied, right, in the previous lectures or the previous chapters. So if the board has made the dedicated risk committee, that means that the board is more serious, more focused, and more committed about the risk management, because now the risk committee can give the dedicated attention and focus over the risk management. They have identified few people among the board who are responsible and who are assigned with this job. This is now their job duty and they have to do this. So this is the second step in the good risk management, right? And then what do? You do a risk assessment, because in order to do a risk management, it is very necessary that first you identify the risk. Because if you are not able to identify the risk, then what are you going to manage? The way I told you in the previous lecture, that before doing the risk management, you have to understand first that what is risk, and then you have to identify it, that what are the risks which you are facing. So how you are going to do this? You are going to first make a list. You are going to make a list of the risks which your company is facing, which are faced by your company. When you have made the list, now what will you do? You will assess the impact and the likelihood of those risks. You will identify that which risk has the high likelihood, high impact. For example, the floods, they have a high impact, but the likelihood is very low. They don't come every day. They don't come every month. They come in a years, right? So the likelihood is very low, but the impact is high. So that is how you are going to assess each and every risk. All right, and then you're going to prioritize them based on the impact and the likelihood. That means that once you are able to assess their impacts and the likelihood, now you are in a position that you can rank them in the order, that which one is the most serious, which one is then the below it, then below, then below, and so forth, so on, so forth. So that is how you are going to do it. First you are going to identify them, then you are going to assess them, their likelihood and the impact, and then you are going to rank them in the order that which one is the most serious for you. And there is a model that is called the heat map, which we will study in the next lecture. It is also used to rank the risk in the order that which one is the serious, which one is the less serious, and lesser and lesser and lesser. All right. And then you, once you have prioritized them, now you got to know that which are the serious risk and which need your immediate attention. So now you are going to plan the mitigating strategies and controls. All right. Obviously, once you have identified, now you are not going to fold your hand and see, okay, these are the risks, and you will pray to God that please remove this risk. No, no, no. You are going to plan the strategies. You are going to plan the mitigating actions to safeguard from them. The way I told you that in order to pass the paper, your risk is that you will fail. So, so you are not going to just pray. You are just going. You are going to study hard, work hard, right? If you have a risk that you will incur the accident, so you will apply all the safeguards, seat belt, airbags, you will drive slowly, you will take a safer route, you will drive with all laws and regulation, and you will apply all the precautions. And also, if you have a risk that your customer will default, so you will check the background of the customer, capacity of the customer, and then you will supply or you will make the sales to the customer to only that limit which he can repay. All right, you will not make the sales above that limit because you know that above that limit he will default. All right, so these are the strategies which you need to make, and for that we use the Tara framework, which we are going to cover in the next class. And then when you are doing all these things, obviously you are in a corporate, you are working in a company, there is nothing which is not documented, so you have to prepare a risk register to formally document all the above steps. Now you're going to make a risk register. Again, this 1 2 3, these all things we are going to cover in the next lecture. All right, I will tell you in detail that what are the contents of the risk register and how you make a risk register, right? And then once you have made a risk register, you have done the risk management exercise. Now the job doesn't end because it's an ongoing activity. Risk management is not the one-off event. It's an ongoing activity. So you have to revisit your risk register again and again and again, because we all know that the environment changes, the circumstances changes. So there is a possibility that based on those environmental changes, the circumstances changes, maybe the impact or the likelihood of your risk have changed. So if it is changed, maybe there is a risk that was lower, but that has come to the top, and you have to obviously plan accordingly for that risk as well, right? So you have to monitor them regularly and reschedule, or I would say re-devise your strategies accordingly. All right. So these are the risk assessment steps, and then you will train your staff for the steps or the for the strategies which you have devised. Obviously you have made controls, you have made the strategies that how you are going to tackle with these risks. So this is done on the board level, this is done on the senior management level, but they are not going to come and carry out the day and day task. These are the employees, these are your staff who are going to actually go through the areas of risk. So don't you think that you need to train them also, so that they can minimize the chances of risk? Obviously, so you will train them. You will appoint a risk manager, right? So the risk manager would be among your management, the lower management, that would be working alongside your staff, who will look after your staff, who will guide them, who will train them, and who will ensure that whatever the strategy the board has made, it is complied by each and everyone. And if someone is not complying with it, that risk manager is going to punish it, right? And you know what? It is usually the company secretary or the CFO of the company. All right. So the CFO and the company secretary are given with the responsibility of the risk manager, and risk manager does all these things. It ensures that all of these things are complied or acted upon properly. And then we have the risk audit. So these are the part of internal audit. Whenever the internal audit is conducted for the different areas of your business operation, business activities, and the business processes. All right. So during the internal audit, the internal auditors identifies that what are the areas from which the risk arising. For example, at your factory, there is a place, there is a place of machine which is very dangerous to work with. All right, there is a cutter in the machine, and that cutter is very dangerous. If someone would put its hand by mistake into the cutter, the hand would be cut. So there is a risk, and that internal audit team identified this, right? So the internal audit team identifies the risk areas, and also they evaluate that whatever the controls, whatever the precautions, whatever the safeguards which you have applied already, are they effective? Are they appropriate or not? And if they are appropriate, whether or not the staff is complying with it or not, whether or not staff is following them to them or not. So the three things: number one, they identify, then they check that whether or not the safeguards are there or not, and if they are there, whether they are appropriate or not. And once they are appropriate, the staff is following them or not. So these are the duties of the internal audit team. Say, so they do the risk audit and identify these all things. So this was all about the risk management process. I hope that I was able to explain each and everything to you in detail. See you all in the next lecture. Till then, take care of yourself. Allah Hafiz.